Uh, Hello once again. Good evening to all the attendees. My name is Kulin Dedia, and I'm from Imarticus Learning. Thank you for all for joining this webinar today. Firstly, Imarticus Learning, we were founded in 2012. We're a leading future tech-based professional learning company. Our programs are pretty much into data science, analytics, artificial intelligence, machine learning, fintech, investment banking, finance, marketing, and much more. Today, we're called upon for this webinar today, which is very, very important and a subject to all of us, which is very, very important, tax planning. Tax planning is vital, isn't it? It's important for us to develop certain strategies to shrink off the tax, and it can be done in a correct manner. Can it be? Yes. To tell us more about this, we have today with us CA Mr. Harish Menon, who will provide us with more insights. Mr. Menon is the founder of EdZone Capital Management, a company that provides financial and tax planning advisory, wealth management, insurance, and investment choices, typically life goal exercises using methodologies to kind of attain all our personal goals. I'd like to welcome him on behalf of Team Imarticus firstly, and I'd like to also give a very warm welcome to all the attendees, those who joined a little before the time and ones who are joining now or a little later. For all our interest, we will be providing you with the webinar recordings. Lastly, I encourage you to use the chat feature for any questions that you may have during the session. We will try to bring it up in the last 15-20 minutes in order to kind of have Mr. Menon answer those ones. So I now welcome Mr. Menon, and I invite him to kind of open the session and grace this. Thank you very much.
Thank you, Kulin. Good evening, friends. Good to see a lot of participants for this program. As Kulin rightly mentioned, tax planning is essential. As someone has rightly said, taxes and death are the two very, very certain things, especially if you're living in India. There are countries where they still don't have income tax. I'm pretty sure that many of you are aware that countries like UAE, for example, or many countries in the Middle East do not have any personal tax at this point in time. But India, obviously with a very large fiscal deficit and not having the kind of oil reserves that most of these Middle East countries have, we don't have the luxury of not having taxes. So it's a very essential part of earning money in India. There will be taxation, no problem whatsoever. Now, the focus today would be to cover taxation from a salaried employee point of view. There are various business heads that I'm pretty sure you're aware of, but I'll be focusing more on what can a salaried taxpayer do from a tax planning point of view. What are the various things that you could probably do? I'm not very sure about your backgrounds individually. I'm not very sure what kind of tax brackets you fall into, but a lot of information would be generic and standard for most of you. If you have any specific questions, you can put it on the chat, and over the last maybe 5 to 10 minutes, I can try and answer as many of them. I hope you can see my presentation. So let's understand what we will do today. So this would be the large structure that we will follow. We will basically understand what are the tax structures that we have and various deductions that is allowed to you, because end of the day, when you say tax planning, we are not talking about how to avoid paying taxes. Whatever is legal, you have to pay, but there are certain deductions that are available. So we could look into that. I'll also give you some practical tax planning avenues which could be used if the case is applicable to you. Now, let me cover some basics, which is very important if you're trying to understand taxation as a structure in India. I'm assuming many of you would know about these basics, but wouldn't really have any harm if we can spend a few minutes on this. I hope all of you are aware of the concept of a previous year and an assessment year as far as income tax is concerned. Whatever we are going to discuss in taxation is all under what is called as Income Tax Act. So it is not something which I or you can understand or interpret in our own way. There are tax laws which are absolutely well in place. It's called the Income Tax Act. So within Income Tax Act, we don't use the word financial year too much. In normal parlance, we say financial year, which obviously for India is April 1st, 31st March. But in income tax, we use the word previous year and assessment year. Previous year is the year for which you are paying the tax. So if you're computing the tax and paying it for, let's say, financial year 2022, that's your previous year as well. So it will start from April 1st, 2021 till 31st March 2022, the current year as we speak. So we are in the February of financial year 2022, which is also technically the previous year as far as income tax is concerned. A lot of provisions that income tax announces, including what is announced in the union budget, will always specify assessment year as their applicability date. So they will say it is applicable from assessment year, so on and so forth. Assessment year is nothing but the year after the previous year. So for previous year 21-22, assessment year will be 22-23. Because technically, once you file your income tax returns, the income tax department will be assessing your income in the next year only. So FY22 is previous year 22, but that is technically assessment year 2022-2023. Same way, if you're talking about previous year 22-23, that is assessment year 23-24. And obviously, that's how the Indian tax laws are structured. I hope you're also aware that for salaried individuals who are not running any business or who are not supposed to have any tax audit done, the due date is July 31st. I have used the word usually because generally the due date gets extended in India. As with a lot of other things, we have this habit of pushing it to the last day and then realizing that the website is down or there is some server issues, and what eventually is done by the income tax authorities are they postpone the date by a month or so. Last couple of years were COVID years, so the due date was extended to as late as December 31st also because of COVID. Otherwise, usually it's July 31st. So once the financial year ends on March 31st, you have 4 months, April, May, June, July, to get all the information that you need to file income tax returns and actually file it before July 31st. It's done online. I hope you're aware now. Everything is done online in terms of filing. And the assessment also happens very fast these days. And if you have a case where you have paid excess tax, you can get a refund out of it, and that also is processed in few working days. So if you file your ITR on July 26th and you have claimed a refund, and if everything is fine in terms of calculations and whatever the income tax expects, you can actually expect to get the refund in a few working days. So that's how efficient the tax system has become over the last many years. Now, as a taxpayer in India, the entire income is divided into 5 heads of income or 5 sources of income as per Income Tax Act. One is salary, which is what we will be focusing on today. The second is income from house property, which largely means you are getting a rental income from some house property you have let out. Please understand, when you earn income from a commercial property, we are essentially talking about it as a business income. So if you have a commercial property which you lease out and you get rental income, that is not income from house property. This is purely your residential house being let out. So there are a lot of people who have more than one houses. They're living in one, but probably let out the other 1 or 2. That will essentially come under income from house property. You have something called income under the head capital gains. Capital gains refers to any gain that you have made by selling a capital asset. Capital asset includes land, gold, equity shares, mutual funds, things like that. So if you purchased an equity share at a lower price and then sold it later at a higher price, that is basically known as capital gains. It is further divided into short term and long term, and there are a lot of things within that which I'm not getting into at this point. Then you have something called as income from business or profession. So Imarticus, for example, whatever income it generates, Imarticus will pay tax under the head income from business or profession. And same goes for me. I will be filing my income tax returns as a professional income. I'm a chartered accountant. I'm doing advisory, so I get a lot of professional income. So that's income from business or profession. It is possible that you might have income from other sources as well. So what is not covered in the first four will go into other sources. For example, interest income is covered as other sources. Any income that you get from a bank FD, any income that you win through lottery, for example, all that comes under other sources. Please understand, as a taxpayer, you may have income from one or all the five heads or a breakup of any of them. So it is very, very likely that your core income is a salary income, but the taxpayer also has a rental income coming from house property. The same taxpayer also has interest income. The same taxpayer also has made some capital gains during the year. So it is very, very possible that you may have income under all the five heads as well. The same taxpayer may also be doing a side business where you're getting some business income. So it is possible. Or it is also possible that you only have salary income and nothing else. No house property, no capital gain, no business income, no other sources. Usually happens when you are early in your career, where you've just started working and predominantly only have salary income at that point in time. So you will have to check for yourself which all head you fall under, and then decide accordingly whether you need to only take one head or you have to take all the heads. Now, from an income tax point of view, when you add all the sources of income under all the five heads, we call it gross income. So your gross total income is all the five heads added up. You don't pay tax on the gross total income. Essentially, you pay tax on what is called as taxable income. So income tax does not charge you tax on gross income. It is on taxable income. Taxable income is gross income after deducting something called as deductions, exemptions, and allowances. I'll talk about that while I go into the session. Deductions, allowances, exemptions can be deducted from your gross income, and whatever is residual becomes what is called as your taxable income. Now, at this stage, I have to tell you very, very specifically, a couple of years back, income tax allowed a new tax regime to be brought in. The old tax regime versus new tax regime, the difference is the new tax regime has more uh, more convenient tax slabs and tax rates. I'll again explain to you the actual slab and rates in upcoming slides. So essentially think of it as a new tax regime where income tax was saying, okay, you pay lower taxes as compared to the old tax regime. I'll make it simpler for you. I'll give you more tax limits, as in exemption limits, and I'll tax you less through lower tax rates. However, if you opt for new tax regime, you cannot use most of the deductions and allowances. So we will talk about a lot of deductions like section 80C, 80D, all that you cannot claim if you opt for new tax regime. So the taxpayers have a choice. They have a choice of whether to go with old tax regime with slightly higher rates, but all the deductions and allowances can be taken, versus a new tax regime where the rates, the income tax rates are slightly higher, but slightly lower, but you will not be allowed any deductions and allowances. So the choice is yours, and you can calculate your tax liability under both the regimes. There are websites available where you can do that. And wherever the tax is lower to be paid, you can opt for that regime. The choice is entirely yours. It is not like the income tax department is asking you to choose one or the other. You choose whichever you want. New is simpler. New is less complicated because it's a very, very simple. This is the income, this is the tax, no deductions, no calculations, no allowances. Old is a little complicated. If you're doing it yourself, you may get stuck in trying to calculate your tax liability in the old. Of course, there are calculators, but you still need to know the breakup of your details and figures. So There is an old regime applicable even now. That is why we will be discussing deductions, allowances. In new, there is no real exemptions that you are getting. Whatever is your income, you will end up paying tax on that. Now, especially if you're a salaried income taxpayer or even in some other income heads, you will have something called as TDS, tax deducted at source. So if, for example, Kulin is working as he is with Imarticus, and when Kulin gets his salary from Imarticus, Imarticus is liable to deduct certain tax from his salary. Income tax authorities have given the onus on the employer to deduct certain taxes from the employee's salary. So technically it is employee's income and the employee is supposed to pay tax on it. There is a lot of focus that income tax have always given on TDS, because employer will be more than happy to deduct the tax from employee's salary because it is not their tax liability, and the government can get more tax adherence and compliance this way. So if you are a salaried employee, let's assume your tax payable officially comes to 100 rupees, out of which maybe the tax already deducted is 70. The employer must have already deducted 70. So whatever is the payable minus the TDS, you will be required to pay that difference as your tax. So TDS is not an expense. A lot of employees also, when even I hire in my firm, they have this problem. They're like, oh, will you deduct tax at source? And I'm like, of course, if it is applicable, I will. And they will be like, oh, I'm not comfortable with that. It's not a question of whether you're comfortable or not. It's the law of the land. If you're earning income where tax has to be deducted, it has to be deducted. There is no other option. But it is not like your salary is going down because of that, because the TDS is anyways your tax paid. So you will be only required to pay the difference eventually. Let's assume the TDS is much more than the tax that you are supposed to pay. Your tax was actually 100 that you were supposed to pay, but due to some reason, the TDS was 110. You will be able to claim a refund of the remaining 10. And believe me when I say this, the refund processing have got really streamlined. So in 99 out of 100 cases, the refund is coming to the bank account in few working days after the deadline. So it's not a very complicated thing. There was a time many years back, whereas a CA, I've seen days where tax refund could take a lot of weeks and months even. But that's not the case now. So TDS is not an expense. Don't be really paranoid when you see TDS. It's just that your tax has been deducted and paid to the government, which anyways you are supposed to pay. You can get a refund if excess was deducted. How do you know how much tax got deducted from your account? How do you know what is the total TDS? How do you know what other taxes has been deducted from your income? You can see all this from a very simple and comprehensive report called Form 26AS. If you go to the income tax website, create your own login into the website, you will be able to see your own Form 26AS. Form 26AS is where you will get all the information about what is the tax that got deducted under your PAN, permanent account number. For everything under the income tax world, your name and address is not the first way of identifying you. It is the PAN. So under your PAN, if whatever tax has been deducted on interest or on rental income or on some business income or on salary, you will be able to see it in Form 26AS. So when you compute your total tax payable, you already know how much has been deducted. Only the remaining has to be paid. Or as I said earlier, if excess is paid, you can claim a refund when you file income tax returns before due date. Please understand, you have to file your IT returns before due date if you want to claim your refund. So be careful. July 31st is a deadline on a usual year. This is the tax rates that I was referring to under the old tax regime and the new tax regime. So if you see, these are the income slabs. This is your total income. These are the various income slabs. And on the left-hand side, if you see, this is the old tax regime with deductions, exemptions, allowances, etc. And on the right-hand side, you will see the new tax regime rates without the deductions and exemptions. So if you see what the new tax regime has done is it has created more income tax levels. So if you see in the old one, there was a 5% slab till 5 lakhs. and anything beyond 5 lakhs till 10 lakhs, it was a 20% tax rate. But now that is not the case. Now after 2 and after 5 also, 5 to 7.5 is one slab, 7.5 to 10 is one slab, and same has been done for more than 10 as well. So if in the old tax regime, you were at a taxable income of, let's say, 11 lakhs, at 11 lakhs, you will be paying a 30% tax rate. But now at 11 lakhs, you'll only pay a 20% tax rate. So the tax rates benefit has been given to you. But what they're saying is, see, I'm keeping it simple. I'm foregoing a tax collection. Understand this. When they're reducing your tax rate for the same income slab, the government income is going down. Please understand, India runs a fiscal deficit. India has more expenditure than what it has as income. So India is trying to collect whatever it can. And if you go for the new tax regime, you will not have any deductions or exemptions. So the choice is entirely yours. At 30% highest tax rate, I'm assuming you are aware that we are not the highest in the world. Countries like US, UK, Germany, they all have 40-45% plus tax rate as we speak. But of course, you also have countries where it is zero tax rate. So the choice is yours where you want to work. But if you are in India, then these are the rates you are absolutely going to be complying with. Now, there is also a 4% cess on whatever is your tax calculation. So whatever is the tax payable, on that tax payable, you have to add a 4% cess. Cess is like an extra tax that the government is collecting. As I said, government runs a fiscal deficit, so it wants as much income as possible. And the last thing is, there is also a surcharge that is applicable. So cess is applicable to everybody, but the surcharge is only applicable if your total income during the year exceeds 50 lakhs, 50 lakhs. If your income doesn't exceed 50 lakhs, you can just ignore because there is no surcharge on your tax. So surcharge is not on the income, surcharge is on the tax, what is payable. So please don't think it is 10% on your income. No, it is 10% on the tax. So if you're at 30% tax bracket and there's 10% surcharge, it is 10% on 30. So your effective tax rate is 33 plus whatever is the cess. So if you're above 50 lakhs and as per the slabs, you can see here, 50 to 1 crore, 1 crore to 2 crores, etc. You have various surcharge applicable, 10%, 15%, 25, 37. So for somebody who has a total income of more than 5 crores a year, you fall into what is always called in India as the super rich tax. The super rich tax is 30% plus a 37% surcharge on that and an additional cess of 4%. It effectively, if you do the calculation, comes to 42.7%. That's the highest that anybody will pay tax in India. Highest. So a Mukesh Bhai Ambani will be at 42.7%. How do I know? Because I can safely assume his income is above 5 crores. 42.7% is the highest. You could be at zero also if you are at less than 2.5 lakhs. I'll effectively tell you that effectively the basic exemption limit is 5 lakhs. I'll talk about that in a while. Up to 5 lakhs, you essentially don't pay any tax. Up to 10 lakhs also, you can plan it in such a way that you will not have any tax. I'll talk about that later. But if you have income more than 10 lakhs, you will definitely have some tax. I know a lot of us in India don't like to pay taxes, but if you are going to follow the law, you have to pay tax. I am not going to talk about tax evasion. I'm not saying don't file your ITR, nobody will find you. That's not the agenda of the discussion. The discussion is going to be how can you officially reduce your tax liability? Officially, not by evading it. Just a sec. So, next point for salaried individuals is a very important thing that you have a 50,000 rupees per annum standard deduction. So earlier we used to get something called as transport allowance and medical reimbursement, etc. They have been done away with. Every year, whatever is your total income, you can deduct 50,000 as a standard deduction. No questions asked. The government is saying, we are assuming that 50,000 is being spent by you on travel and medical expenses. I will give you the benefit for that. So straight away, 50,000 is your standard deduction. It is like saying that my income is 5 lakhs, but I will reduce 50,000. Now it is only 4,50,000. No questions asked. You don't have to submit any proof, anything at all. However, please remember that this standard deduction is not applicable in the new tax regime. It's only in the old tax regime that you will get this 50,000 standard deduction in a year. There is also a very interesting section in income tax called section 87A, where if your taxable income is not over 5 lakhs, so remember 2.5 is the basic exemption limit, 2.5 to 5, there is a tax calculation, but the government has introduced a rebate of 12,500. Rebate means when you pay tax, you will actually get a deduction of 12,500 from the tax. Standard deduction is a deduction from the income. Rebate is always a deduction from the tax. So when you calculate your tax liability, if your income is below 5 lakhs, you will get a 12,500 tax rebate, which is like a tax deduction, which means if your tax payable is, let's say, 14,000, you can straight away apply a rebate of 12,500 and only the balance has to be paid. So if you do the calculation up to 5 lakhs, effectively your tax will be zero, because there will basically be this 12,500 also that you're getting a benefit out of. So government is very clear, up to 5 lakhs, I don't want to tax you. I will go with higher income people who will end up paying the taxes. That's what is logical, right? I mean, more the income, more the tax you will pay. Less the income, you should not be having any tax liability, because 5 lakhs a year is about 40,000 a month. At 40,000 a month, if you are the sole breadwinner, it is not a lot of income in current context to actually save out of. So that's why the government is very clear. Effectively, I will give you a rebate. Now, a lot of people ask, why rebate? Why not just create a basic exemption limit? The reason is they want more and more people to file their income tax returns. If you're under basic exemption limit, you don't have to file your ITR. But if you're about 2.5 but below 5, you file your ITR and then can show the calculation where you have taken the rebate, so that at least they know the data about how many people in India have that kind of income. Because don't forget, they could be going into higher tax slabs later. So government can estimate their tax revenue for future years that way. So basic exemption limit is not 5, but there is a rebate you can enjoy, which effectively means up to 5 lakhs, you have no tax at all. Now, what are the various deductions available in the old tax regime? Under the new tax regime, this doesn't apply. So you have to be very careful which one are you taking. You know your data, you can simply calculate tax as per old regime, tax as per new regime, whichever is lower, you go for that. So there are calculators, as I said, available for that. What are the various deductions available? The first and the most common one is Section 80C of Income Tax Act. Rupees 1,50,000 per annum is available as a deduction from your total income. So when you calculate your taxable income, this 1,50,000 will be deducted if you have actually invested the amount in any of the things mentioned on the screen. This 1,50,000 is a total limit applicable to all the investment components. So it's not 1,50,000 per investment component, it is total. Now there is no breakup that you have to worry about. You can invest the entire 1,50,000 in one of these investment avenues. What are these? First, Public Provident Fund, PPF. I hope you're aware there is a PPF account that you can open through a bank. Up to 1,50,000 rupees per annum, anyways, you can invest in PPF. PPF also has a limit of 1,50,000 per annum. You get interest rate from the government at the rate of 7.1%. Keeps on changing every year, but currently it's 7.1% tax-free. PPF income is tax-free. This is the best fixed income product available in India from an investment point of view. No other fixed income product can give you 7.1% tax-free, which is effectively almost 9 to 10% pre-tax. So a 9 to 10% returns from the government of India, which is secured. No other investment avenue can give you a guaranteed fixed income. You can get more from equity, but there is risk also. If you have seen over the last 1 month, equity has been giving losses. But PPF, Public Provident Fund, absolutely safe and at a very good tax rate. So a very good income rate, sorry. Second is Employee Provident Fund, EPF. So if you are working in a company, there's a deduction from your basic salary that will go into EPF. That contribution also is a part of Section 80C, 1,50,000. Any life insurance premium you pay to any insurance company, be it LIC, be it HDFC Life, be it any private life insurance company, any life insurance premium you're paying, be it for term plan, be it for any type of insurance plan, the premium is calculated in section 80C as a part of 1,50,000 per annum. Next is equity linked savings scheme, ELSS. It's a mutual fund scheme, if you are aware of it, which will invest in equity markets. So you invest in a mutual fund ELSS, they will invest in equity portfolio, and whatever is the returns will be subject to market risk. And whatever investment you make in ELSS is a part of this 1,50,000. Principal component of your home loan EMI. If you're paying home loan EMI, whatever is the principal component, EMI has principal and interest component. The principal component is a part of section 80C. Then you have various government schemes like Sukanya Samriddhi Yojana, SSY, Sukanya Samriddhi Yojana. It is for a girl child that you have. If you're saving for her future education, whatever investment you're making in this investment plan for a girl child. If you don't have a girl child, then SSY is not applicable to you. If you do have a girl child and you're saving for her higher education, then that investment that you make in Sukanya Samriddhi Yojana is also a part of section 80C. Understand, it's a total 1,50,000 that is applicable. So if you invest 80,000 in SSY and 80,000 in PPF, you have invested totally 1,60,000, but only 1,50,000 will be available as a deduction. Only under the new tax regime, not in the only under the old tax regime. Sorry, not available in the new tax regime. NSC is National Savings Certificate that you invest with the post office. NSC. SCSS, Senior Citizen Savings Scheme, only applicable to senior citizen above the age of 60. So if you're a senior citizen, then you can invest in Senior Citizen Savings Scheme of the government and get the tax deduction. You also have 5-year tax saving FD with a bank. You have to invest for 5 years in FDs, which are notified by the banks, normal banks around you. They will take an FD from you for 5 years. Obviously, you will earn some interest. Such FDs are also under section 80C. So if you are a young taxpayer, do advise your investment advisor how the best way of combination can be. For me, to be honest, the most preferred ones which I tell my client is insurance premium, because insurance is a must if you are a breadwinner for your family. Second is PPF. You get as I said, 9 to 10% fixed income. It's a very, very good investment avenue. The third is ELSS, equity. So you're investing in equity linked savings scheme. These are the main heads available under section 80C, only under the old tax regime. I'll take specific questions later on in the last few minutes. So I'll just cover everything before that. Medical insurance premium, section 80D, any premium you pay for your health insurance, which is called Mediclaim popularly, that will be also a deduction available under section 80D. It is 25,000 per annum for yourself, spouse, and dependent children. So if you have a family floater plan of health insurance and you're paying any medical insurance premium, up to 25,000, you will be given a deduction. If you pay more than it, you can pay, no problem. You can pay 1 lakh also, but only up to 25,000 deduction available, only in the old regime. I repeat, none of it is available in the new regime. You get an additional 25,000 for parents below the age of 60. And this 25,000 actually is above, it's actually 50,000 if the parents are senior citizen. So 25,000 for yourself, spouse, and children. Another 25,000 for parents below 60, and 50 if they're above 60. So that's how you can take medical insurance premium for your medical insurance policy for your family and get tax deduction under the old regime. You have section 80E, where any interest you pay on educational loan, again, not all the loans, not all the courses are covered. You need to check from your tax advisor whether the course you are planning to do is covered under the educational loan 80E. If it is covered, then any interest you pay on educational loan for 8 years, the first 8 years, whatever you're paying as your interest is totally deductible from your taxable income, from your income. Totally, no upper limit. So if you're paying an interest of 20 lakhs per annum, just assume that is also going to be allowed under section 80E, provided the course for which you have taken a loan is an approved course. 80EE is a special section where if you're a first time homeowner, you're buying the home for the first time, not second home, third home, fourth home, the first home that you're buying, you will get a special 50,000 home loan interest deduction if you're a first time homeowner. Again, when you're paying EMI, the interest component, you can get a special 50,000 benefit out of that if you are applicable for this. Donations, government wants you to make donations if you can. So donations made to approved charitable organization will give you a tax deduction. In the old regime, the tax deduction is either 100% of the donation done or 50% of the donation done, depending upon where did you donate it. So certain NGOs are under the 100% bracket, certain NGOs are in 50% bracket. The entire list is available in income tax website and you can Google them. Any deductions, any donations you're making, some of it you will be able to claim as deduction under the old regime. So as I said, I'm just covering the more important ones that will be useful to all of us. If you get any interest on your bank savings account, you have savings account balance and you're getting interest up to 10,000 rupees is not taxable. So if you remember, interest income is a part of income from other sources, but up to 10,000, no tax to be paid because you have section 80 TTA subsection 1. Don't remember the tax sections. As a chartered accountant, when you study, you remember all these sections and you have to write in the exam, but you don't have to, fortunately. You can always look up in the Google and find out whatever section you want. Then we have section 80 TTB. A lot of these new sections keep coming up. This is for senior citizens only. Any interest senior citizens get on bank interest, post office interest, any interest, 50,000 rupees is not taxable up to 50,000. Because again, senior citizens, please understand their main income could be interest income. They don't have any active income. So government is not, harsh. They don't want everybody to pay the same tax. They're giving a benefit to senior citizens saying, okay, we understand it is your core income. Don't pay tax up to 50,000 in a year if you're getting interest from banks, post office, etc. This is just a summary of various things you can do apart from what I mentioned. So for example, if you have kids and you're paying for their school fees, then that is also a part of section 80C. I did not mention it because not all of us will have kids when we are in the tax paying status, right? So if you have kids, then you can claim their tuition expenses also as a part of 80C. Some of it I already mentioned in this particular case. If you have a disabled dependent, disabled, again, there's a definition of what is disabled. Then again, up to 75,000 per annum, you can get as a deduction if you're paying for their expense in section 80 DD. And if it is a severe disability, up to 1,25,000 is allowed. As I said, there are a lot of these deductions available. The PPT will be shared with you. You can go through it later. I'll talk about house rent allowance separately, HRA. That is a separate slide coming up. House rent allowance. If you see your salary income breakup, if you see the breakup of how your salary is computed, most employers will have a breakup called house rent allowance. So you might have a basic salary, then a house rent allowance, then some other allowance, and the total will be whatever is your cost to company. If you have seen your form 16, if you see your salary deduction. So there is a house rent allowance you can claim. It's a very, very useful thing for all the salaried employees. So very useful. Please make use of it. So if you're living in a rented house, you can claim the house rent allowance. Please understand. So if you are living in a rented house, you don't have your own house, then you can claim this house rent allowance. How much can you claim? I'll tell you the limit, but again, not applicable to the new tax regime. So I told you, right? New tax regime means lower taxes. So they're saying opt for lower tax rates, forego all your deductions, or go to old, compute everything and pay a higher tax rate. The deduction that you can get in a year is the lower of these three, lower. Whatever is the actual HRA benefit you are getting from the company. So look at your tax components. There will be a there will be a house rent allowance, HRA. Whatever is that figure is the first number that you have to compare. Second, 50% of your basic salary plus dearness allowance. Most private company employees don't have a dearness allowance component, but if it is there, basic plus DA, 50% of that. So if your basic salary is 10 lakhs, your DA is 11 1 lakh, 11 is the total. So 50% of 11 is 5 lakh 50. You have to take 5 lakh 50 as the second figure if you are living in a metro city. Again, defined under Income Tax Act, metro city is defined. So Mumbai, Pune, Kolkata, Chennai, all the major cities are in metro, and 40% if you're in non-metro. If you're living in tier 2, tier 3 cities, then 40% of basic salary plus DA. So please understand the first figure is actual HRA. Second figure is either 50 or 40% of salary plus DA. And the third figure is the actual rent that you are paying. The actual rent that you're paying less 10% of basic salary plus DA. So looks a little complicated, but it's not that complicated. You have a HRA in your salary component, take that figure, take your basic plus DA, add and take 50 or 40% depending on where you live. That's the second figure. Third figure is the actual rent that you're paying less 10% of basic plus DA. So if your actual rent you're paying is 5 lakhs, your basic plus DA is 11 lakhs. So 11 cut 10%. You have to deduct 1 lakh 10 from 5 lakhs. If these three figures, lower of all of this, you will straight away get a house rent allowance. So if your total salary is 15, whatever the lower of the three, suppose the lower of the three comes to 4 lakhs, that 4 lakhs will be deducted from your total income. Not complicated if you actually go about it, and there are calculators available. My job here is to make you aware that there is a house rent allowance. Please opt for it. And I'll tell you a very, very important thing that many tax payers are not availing of. You also can claim your house rent allowance and interest on home loan together. So if you are having your own house, but you're not staying there, you're staying in a separate house, paying rent, you can claim both of it, as I said earlier, in Section 80C as well as this house rent allowance. So don't think that if you have your own house, the problem will come. No, as long as you're not staying there, it's still fine. Most importantly, which may be applicable to a lot of you, you can claim rent that you can pay to your parents, something that people do not know. Income tax considers your parent as a separate income tax assessee, and you are a separate income tax assessee. So let's assume you're living in a house with your parents, which is a very common thing in India, unlike the Western world. And the house is owned by, let's say, your dad, or jointly by your dad and mom, let's assume. And you're living in that house and you're like, it's my house, right? You say it is my house, not for income tax. Income tax will say Harish Menon's father's house is Harish Menon's father's house, not Harish Menon's house. So Harish Menon can pay rent to his father, which obviously the father has to show as income. Please understand. Nobody's evading taxes here. It's not like, oh, how is it fair? I am showing a rent expense. Yes, you are showing a rent expense. Father will show a rent income. Let him pay the tax. Because for income tax, father is a separate taxpayer. Child is a separate taxpayer. Why are you considering it as a family? Yes, your family, but not for income tax. Income tax will say father is a taxpayer, mother is a taxpayer, son is a taxpayer, daughter is a taxpayer. You can pay rent to your parents. If you're two siblings, like brother, sister, two brothers, both can pay rent and both can claim it under their HRA. But don't forget, nobody's evading tax. You know, the benefit will be when, if your father is retired or in a slab which is lower than your tax slab, that will help a lot, because your deduction will be under a higher tax slab and your father will probably end up paying tax under a lower tax slab, or they may even be retired. So they will actually probably not have any taxable income up to 10 lakhs also. So the point I'm trying to make is, when you say rental, it's not just about actual flat taken on rent. It is also applicable if you are living in your parents' house. Spouse is not covered, just to clarify. So a wife cannot say I'm paying rent to the husband and vice versa. That is not covered. I'm just being very, very clear. It's only parents. If you do not have a HRA component in the salary, let's assume you're actually paying rent, including rent to your parents. You're actually paying rent. If you look at the 3 deduction slab, one is rent paid, other is that 50%, 40%. Third is actual HRA. Let's assume your employer has not even created a HRA slab. They are not creating a slab. Still no problem. You will still be allowed a deduction of lower of these 3. So if you're actually paying a rent, including to your parents, you can always pay a rent to your parents. You can still get a HRA deduction from your income tax, even if there is no HRA component in the salary. So That's a very important thing that I think most of you should take use of. Second tax planning avenue, which a lot of assessees do, create a Hindu undivided family, HUF. You can create a separate legal entity called HUF, Hindu Undivided Family. What is a HUF? It's a very easy thing to create. It's a very simple legal formality to create it. HUF, the advantage is it is treated as a new tax entity under the Income Tax Act. So Harish Menon can create an HUF and the HUF will be a separate tax entity. So a lot of income you can show in HUF's name. You can do investment through HUF. You can own property as through HUF, not in your name, so that rental income will become HUF's income. Investment income will become HUF's income, and you get a new tax deduction if you understand, up to 10 lakhs. If you're not paying tax, HUF also will get another 10 lakhs. So your total income you can divide among various legal entities. HUF has its own legal entity as far as income tax is concerned. HUF can only be created by Hindus, Buddhists, Jains, and Sikhs. I am not trying to create any divide. This is the law. So unfortunately, if you're from a religion or a community not covered in this, the HUF is not applicable as an entity for you. It is only for Hindus, Buddhists, Jains, and Sikhs. I have no idea. I have read about it when I was doing CA about the logic. I've done CA long back and I don't remember it anymore. HUF can take an insurance policy on life of its members. So if you want, you can get it. You can get a concept where your entire family's life insurance can be taken by HUF and amount can be paid from there. You can also get salary from HUF if you're contributing to its functioning. You can invest through HUF on investment returns on HUF. So it's a very simple thing. Let's assume you're a family of husband, wife, 2 kids. You're creating one more legal entity for all tax saving purpose. So that's the basic logic. It's a simple tax saving tool that you have. The rate applicable to HUF is the same as individual. So whatever rates I showed you in terms of slabs, the same slabs are applicable to individuals. So it's like simple. Your income is X. By creating HUF, you're splitting it. I mean, the splitting also has to be done logically. You can literally have 2 entities having 2 different tax slabs and obviously then a lower tax rate. This is a very interesting thing that I want to talk about. National Pension Scheme, NPS. It was introduced recently, few years back. NPS has an additional 50,000 deduction under 80CCD 1B over and above the section 80C 1,50,000. So 1,50,000 has a lot of investment revenues I spoke to you. NPS has a separate deduction available of another 50,000. So if you invest in NPS up to 50,000, you will get additional tax deduction. Again, applicable only under the old regime. Most important, if employer contributes to your NPS, if you tell your employer, see, you're paying me a salary of so much, right? Don't pay me this much salary in hand. You invest into my NPS, which is a long-term retirement fund you're creating. Then up to 10% of your basic plus DA. So let's assume you have income of 10 lakhs and you tell your employer, you know what, deduct 1 lakh from my 10 lakhs. Don't pay me as basic salary or any allowance. Just invest that 1 lakh on my behalf in my NPS account. Just have to give you an NPS account. So what will happen is, instead of you taking 10 and investing 1 in NPS, you're getting 9, 1 is getting invested. That also effectively will save your tax. Why? If you get 10 and then you invest, obviously only 50,000 allowed. You ensure 1 lakh also gets invested additionally. You only take the 9 part. So you will pay tax on 9 only, not on that 1. Huge tax benefit that you can get out of this. So literally 1,50,000, if you can imagine, can be saved as your NPS income. So whatever you're paying as NPS, not income, sorry, whatever you're contributing towards NPS, you can. Okay, how is it taxed later on? So whatever you're investing in NPS, there are various schemes you can opt in NPS. You can go for pure equity, pure debt, hybrid. There are a lot of options under National Pension Scheme. Once you turn at the age of 60% of that NPS corpus, whatever has been accumulated, you can withdraw it at that point without any tax. The remaining will be converted into annuity. Annuity means you will get monthly income out of that. And as we speak now, the monthly income is taxable, but government is talking about making that also tax free. So there is a huge tax advantage eventually also when you withdraw the NPS amount when you retire. Not only that, whatever you're contributing also gets a lot of benefit. What are the other tax planning avenues that you should know? You can gift amounts as money or as shares, equity shares, for example, to your spouse. Gifting is a non-taxable transaction. So let's assume there's an example where one of the two in the married couple is earning, let's say, 25 lakhs per annum, and the other, husband or wife, whichever, is not earning income. Let's assume they're taking care of the house and kids. And I'm not assuming that the wife will take care of it. There are a lot of families where the wife is the earning member and the husband is taking care of kids and house, whatever be the case. So one spouse is earning 25 lakhs, the other spouse is not having any income or having an income but very less, 4 lakhs, 5 lakhs only. And this 25 lakhs income is in a very high tax slab. This person who's earning a higher income can, once in few years, not every month, not every year, once in few years, can give a gift to the other spouse. So for example, I'll give a gift of 25 lakh rupees to the other spouse. So that 25 lakh rupees transferred is non-taxable. Gift is non-taxable for the recipient. And that 25 lakhs can now be invested in the other spouse's name who was probably having less income. That investment income, whatever you are now getting, goes into lower tax slab. You will not have to pay higher tax slab because you technically the other person is at 25%, 25 lakhs, or even at a 30% tax rate or a 42.7% tax rate. There can be gifting that can be done. So the basic logic is the one who's at a higher tax slab gifts shares or assets, can be property also, or money to the other spouse, so that overall the tax liability can be worked out. So this gift can be given. There has to be a gift deed that is prepared, and that gift deed will be asked by the income tax authority if they want to, and under that you can easily save taxes. So use it if you're not. If you have any investments in equity shares or mutual funds, anything where currently your portfolio is at a loss, like in this year, it is very possible that since October, if you see, the market has been doing negatively, equity market. So it's very likely that many investment you have done in the last few years could be at a loss at this point. So let's assume your investment value is 10 lakhs and the current market value is 8 lakhs. And you're a long-term investor. You don't care about this 2 lakhs loss as of now. You're like, this 8 lakhs will go up over a period of time. No problem. Your investment is 10. Your market value is 8. Sell this holding. Book the 2 lakhs loss. Reinvest the 8 lakhs again. So there is no difference in your portfolio. You sold and reinvested. You booked this 2 lakhs loss. This 2 lakhs loss can be used to offset some other gain that you might have. You might have some gain from property. You might have some gain from other bonds. You can offset it. So book losses wherever there's unrealized losses and use it to offset other gains that you might have. That is called tax harvesting. Use it judiciously every year. So every year, what sophisticated people who know about it do is they will sell all their loss-making investments, reinvest it. See, it's a long-term holding, but at least book the loss. If not this year, at least in future years, you can use that loss. Unabsorbed losses are carried forward. So you can use it next year when there is gain also, and your tax liability can be lower because of that. It's a very logical thing to do. This year is a brilliant opportunity. Before March 31st, you have to sell, book some losses, whatever you already have. So you're just converting unrealized losses into realized losses and benefiting out of that. You can also, if you have cryptos, book your gains on cryptos. I hope you're aware, budget of this year has announced a tax on crypto from next year. So if you sell before March 31st, you will be able to avoid the tax on cryptos if you have any profits on cryptocurrencies, if at all you have it. If you don't have it, ignore it. Don't worry about it. As I said, please think of paying rent to your parents. Have a rental agreement. Very, very much a good way to claim HRA, house rent allowance, especially if your parents are in lower tax slab or retired. Makes a lot of sense. If they're also in your same tax slab or in a higher tax slab, then don't do this because they will end up paying a higher tax than you. If you're thinking of taking a home loan, take a joint home loan with your spouse. Don't take a home loan only in your name. When you take a joint home loan with your spouse, both of them get all the tax benefits applicable to a home loan. Both of them will get Section 80C limit separately. Both of them will get interest benefit separately. So you're creating two benefits instead of one if you take a joint home loan. This is it's a simple calculation where up to 10 lakhs of salary income, you can end up paying no tax. How? If your salary income is 10 lakhs, you get a standard deduction of 50,000. Your Section 80C can be 1,50,000, and these are not wasteful expenses. These are all investments for future. You have your NPS contribution, as I mentioned, additional 50,000. You can have your home loan interest or HRA up to 2 lakhs. You can have medical insurance 25,000. For senior citizens 50,000. Your net tax payable will become zero after the rebate. So there's a simple way of, up to 10 lakhs also you will be at no tax. If your salary is less than 10 lakhs and you're paying taxes, consider using some of these options that is available to you. Of course, about 10 lakhs you have to pay tax. If you are earning more, why not pay more tax? Please help the government get some revenue. That's where I stop. Before I proceed, I am putting my number and email ID on the chat so that even if I am not able to take questions now, you can reach out to me later. So you can see on the chat my number and my email ID. Whatever questions I'm not able to answer now, I'll be happy to later on. Thank you for giving me an audience. I'll take some questions. I'll leave it to Kulin in terms of moderating that. Please, Kulin, if you can.
Yes, thank you, Mr. Menon, for that insightful 1 hour. I have a few questions here, and I think we will take about 2 minutes to kind of just take those. Just a very quick one. If you invest in shares, then there is a way to cut slab in tax. I'm not sure whether I'm not able to really take that, but maybe you can just have an answer to this.
Anonymous attendee, I like that. So there is no tax benefit on direct equity investment anymore. There used to be earlier, but not now. It's only if you invest in mutual fund through equity linked savings scheme. However, not in direct equity.
Okay. I think then again, there's the same question by anonymous attendee. What we are living in a leased house, can we claim HRA? So
yeah, if you live in a rented house, you can, yes.
And I have a last question. If spouse is not working, then can be taken a joint home loan?
Yes, absolutely no problem. Banks do not really have a problem with spouse not working. The loan can still be a joint loan. In fact, a bank usually prefers to have two people taking a loan, because if something happens to one, they can still have somebody else. So they usually will kind of ask you to have your spouse in the agreement or your mother or father, usually if you're not married. So yes, you can. The answer is yes in a simple way. Sure. No problem, even if he or she is not working.
Right. And I've got two more questions. I think we will take this as final ones. I've got one more saying, what is a better tax slab for a newly joined salaried person whose package is 10 lakhs? Is it the old regime or the new regime?
So Akshay, the tax liability will be slightly higher in the new regime for up to 10. However, with the rebate, your tax will effectively be very less. If you don't have a lot of obligations, when I say obligation, you are not really using most of your income for expenses, living expenses, etc., then I would suggest you use the investment options of the old regime, Section 80C, NPS, etc., thereby save tax rather than go to new regime. But if you obviously have a lot of expenses where you're not able to save, see, when I spoke about 80C and NPS, all that can be done if you can save, right? If you have a family, you're the only breadwinner and all your money is going into living expenses, then all those deductions are not useful for you. So you have to think in your own case. If you can invest, use the tax benefits under the old regime. If you're not able to save much, be in the new regime, that will be effectively lower tax for you.
There's a final one. Sir, if you can take this one. If I sell house an entire money, 30 lakhs come to account, will it be taxed?
Absolutely. So there are two ways in this. One, the seller of the house is supposed to deduct a tax, a TDS on the value of your sale consideration, which many of them are not doing at this point in time, but the seller has to deduct a certain tax. Even if they don't, or even if they have, the I'm sorry, my bad. The buyer has to deduct a tax because the seller is getting the proceeds. Even if the buyer has not deducted the tax, the seller still has to obviously calculate the tax liability and pay it. At source, the entire tax is not deducted. It is only a certain percentage of the sale value that is deducted. The rest of the tax, the seller has to compute and pay whatever is the applicable law for that.
Sure, sure. Yeah, I think
Just one sec, sorry. I think I've sent the chat only to host and panelist. My contact details I will share with everybody. So
right.
yes, now everybody can see. That's my contact
Perfect.
number and email ID.
Okay, one final one Akshay has again. Is there an option to change tax slab option next year? And that's personally even important for me. When does this happen and how does this happen? Do we inform to our investment advisor?
So you, as a salaried employee, there is no limit on changing the slab. If you are not in salary, then you can only change it once.
Okay.
Salaried, no problem. You can change next year also if you wish to. And there is no need to inform anybody. The income tax pretty much will know when you have shown your calculations, what regime you have chosen. In the form, in the ITR, they will be able to figure out.
Sure.
There is no need to intimate anybody for that.
Perfect. I think that's pretty much it. Uh, I'm not sure. In the interest of bandwidth, dear attendees, if we should take or not. But I just happen to enjoy this session. Mr. Menon, thank you very much. Please use his email and his phone number. Do reach out to him. As mentioned, he's the founder for Edge Zone Capital Management, which takes care of all your insurance, investment, tax planning, and financial advisory. It was lovely seeing you, sir. And thank you once again. We will be sending the recording to all the participants who made it and who didn't make it as well. So thank you. Thank you very much, everyone. Thank you, sir.
Thank you.
Thank you. Karthik, you can just share the feedback, please. Thank you.
So just quickly answering a question asked by Soumya. If one person is not earning, how will that person pay tax? So it's not about who is paying. The income is not important. The account is the joint bank account. In joint bank account, the husband and wife are joint owners. If you have seen it, who contributes into that bank account is not relevant for the bank or the income tax authorities. So don't worry if one of them is not earning. The account is the common account where the one who's earning can contribute. There's a feedback form which has been shared. Please fill that.
Yes, please do log into that link. It's a quick 4 questions. We really appreciate your feedback. Thank you once again. We will keep this live for some to kind of answer in the meantime. Have a good evening. Thank you very much, all of you.